For the first time since 2020, the Central Bank of Nigeria has cut rates by 50 basis points to 27%. Inflation may be easing, but tight liquidity remains a challenge. So, what does this mean for Nigeria's fixed income market? To answer these questions, I'm joined by StoneX's head of fixed income for Sub-Saharan Africa, Afamefuna Umeh. Welcome, Afamefuna. How are you?
I'm fine, and you?
I'm very well, thank you. So let's start with the basics. Can you walk us through the latest CBN decision and what it signals for monetary policy going forward?
The latest CBN policy in terms of monetary policy in cutting rates by 50 basis points is the first time in 3.5 years since that's happened. What that signals is that they're moving away from the tightening stance to a more, sort of cautious easing stance in terms of their policies. We've had inflation easing, and it's to the reaction of that we have rates now cut by 50 basis points. Now, in terms of the market and in terms of the perception, 50 basis points is still a bit cautious. In the grand
Hmm.
scheme of things, it hasn't really shifted in terms of a lot, and then focus is still on how to sort of manage inflationary control, and then signal some sort of support for economic growth from the Monetary Policy Committee, but then with one eye on liquidity in terms of how it affects FX and the currency depreciation. So overall, it's a good step in the right direction that we're now looking to economic growth, and they were now looking to cautiously ease as against an aggressive easing. But then the system is liquid, and then this has impacted yields as well.
Now, as you know very well, there are always risks attached to any rate cuts. How did markets react immediately after this latest one?
Markets after the rate cuts, we saw yields in bonds and treasury, mostly treasury bills, coming lower. Market is still relatively very liquid. We had at least 6 trillion in terms of liquidity, and we still see local players and international players in the market, trying to take advantage of higher yields, because the projection is that yields are going to come down and
Hmm.
the easing will continue, albeit cautiously, and also towards the end of the year, November, where we're looking at another round of cuts as well. So the idea is that yields will remain lower, but then we know that in terms of borrowing, the government still has a deficit, so the government will continue to borrow, and they will continue to issue, to mop up liquidity as well. We still see OMO auctions to basically renew or to reissue maturities to be able to take care of that liquidity as well. But system is still relatively very liquid.
I see. And in a previous conversation, we actually discussed Nigeria doubling its bond issuance. Now, with the rates at this new level, how does that shift the balance between supply and demand?
So for supply, I would say that nothing is going to change. The needs of the government still remain the same. So we still expect them to, issue to the extent, the volumes they've done. For demand, we see demand increasing because as yields come lower, there's reinvestment risk. There's still a lot of liquidity in the system, like I alluded earlier. And for demand, you see local demands from, from the banks, from the funds, from insurance companies. These local players would continue to, invest in local securities and local bonds. So we see the demand still high, and the government will continue to issue at the pace, and the volumes they've been issuing as well.
So you just mentioned actually domestic institutions being the primary buyers, right? So what role do foreign investors play in this environment?
So for the foreign investors, I mean, the yields are attractive, right? And the foreign investors have been in the market for a while now. And we're also starting to see increased appetite in terms of, being able to lock in yields, at high levels. Coupled with the local players, the foreign players are in the market actively, and the OMO issuances that you see cater for, that demography in terms of the high yields that they receive. We see OMO bills coming 20% and above in terms of rates. And this is, very attractive for the foreign investors. And with the FX stability and with the FX policies of the government being able to harmonize the market, it gives some confidence in terms of, reducing repatriation risks and also giving comfort to investors that, they can have value, when they want to sort of exit whatever holdings they have. But at the moment, the foreign investors are in the market and they're active and they're staying and they're taking advantage of the high yields at the moment.
So then, given this context, what should fixed income investors be doing at this stage?
I mean, short term, it's attractive. You can see with yields coming lower, it's an opportunity to lock in for high yields, for both local and foreign investors to be able to take advantage of, where the market is at the moment. Because on the long run, we expect yields to come lower as we continue to cut rates and as inflation continues to come down. So I think massively, why the demand has increased is because, people are buying, and that is where we expect market to be, for people to continue for it to continue being bullish, the underlying trend to continue being bullish while investors keep coming to take advantage of these yields.
Afamefuna, thank you so much for your time, and hopefully we'll be able to talk soon.
Thank you so much.
And thank you for watching. For more financial content, don't forget to like and subscribe to our channel.